Hello. Well, today I'm going to be looking at 3 possible ways you could release money from your home to make your retirement a little easier. And I'm going to be looking at a fantastic new Facebook group that's aimed at us, the pisky older generation. Welcome to Grey Matters. Hello there and welcome to Grey Matters, the channel that promotes the fact that the older generation still matters and looks at issues that matter to the older generation. Please feel free to give us a thumbs up and subscribe to the channel. And if you're wondering why the baseball cap, well, I did a video recently that explained I was undergoing some treatment for some sun damage to my forehead. Sun damage in the UK. Who'd have thought it? Now, I'm no financial expert, I have no qualifications, and I'm not going to be giving you any advice whatsoever, except for maybe do your research. The information I'm giving you, you can get anywhere. The difference is perhaps that I'm not trying to sell you anything. So hopefully the information I give you is fair and balanced. Whether equity release is right for you depends on your circumstances. There are pros and cons to all of them, and they vary with the product you choose. The main 2 choices are lifetime mortgages and home reversion plans, so let's take a look at them. Our lifetime mortgage is by far the most popular. It provides you with a lump sum of money which is tax-free. But you can, if you wish, choose a lifetime mortgage that has a drawdown facility. That means instead of a lump sum, you actually get a reserve bank account where all the money is kept. And you draw down on it as you need to ease your retirement, to help your monthly spending, planning, maybe pay for that holiday that you've been looking for. The main advantage to that is that you'll pay less interest than if you just get a lump sum, because you're only going to pay interest on the amount of money that you withdraw at any particular time. So it can save you money in the long run. Now, there is a big pro and a con wrapped up in the same parcel with a lifetime mortgage, because the main pro from this is that you won't be paying any interest each month, which is great, isn't it? No monthly interest repayments. Yeah, not quite as it seems, because that interest obviously has to be paid, and generally it's all added on at the end when you either die or you go into long-term care, and it means then your house has to be sold to pay off that debt. Now, it can be a lot of money. With a small mortgage such as £40,000, you could be paying £90 a month interest, or the equivalent of, which is about £35,000 interest tacked on the end of your estate at the end, depending on interest rates, of course. So your loved ones could be faced with a bill for £75,000 or more at the end for that £40,000 that you originally borrowed. Now, you can, if you want, pay monthly interest. If you can afford to, you don't have to all the time, but every now and again you can bung a bit of money in. It'll all help to reduce the interest paid at the end. Some people with maybe £90 a month interest will opt to pay £100 a month in, because they chip away a little bit at the balance and they also pay the interest each month. So when the estate is realised at the end and the loan has to be repaid, you don't generally end up with that massive interest bill at all, and you've reduced the amount of money you're paying interest on anyway, and that's well worth doing, in my view. Now, with all these equity release mortgages, lifetime mortgages, where they are provided by an approved provider, there should be a negative equity guarantee, and that means you will never pay back more money than the value of your home. And that's important to realise. If you go to someone that's not approved, you could find you've got no protection. If you go into negative equity, tough luck. So do make sure you go to an approved provider. So what are the main cons from a lifetime mortgage? The main problem is that your family won't inherit the home. If they wanted to keep the house, they couldn't, because it's got to be sold, either when you go into long-term care or when you die, because the mortgage has got to be paid off. It's possible you might decide, well, I'm going to avoid that. I'm going to pay the mortgage off early as soon as I can. That sounds fine, but they are a lifetime commitment, these mortgages, and they're difficult to get out of. And if you do, you'll find that you've got an early repayment charge to pay, and that could be exorbitant, could be a lot of money. It's also not a suitable option if you're living with dependents, because if you have to sell the house to pay off the debt, you're making people homeless. So it's not a good option if you've got anyone living with you who's a dependent. Another issue is that they have fixed interest rates, and that means that the interest will continue to roll up and roll up through the lifetime of the mortgage, for the rest of your life. And that means the debt to the lender can be extremely costly. You also can't take out any other loans secured on your home while you've got one of these lifetime mortgages. And in fact, when you apply for the mortgage, if you've got any outstanding debts, you have to use the money from that lump sum to pay off those debts. And this one is very important. If you take out a lifetime mortgage or any equity release, you can find it can impact on your means testing. If you wanted certain benefits like pension credits, it will have an adverse effect on that. So keep that in mind. Now, the second possibility is what they call a home reversion plan. Now, this is where you sell a portion of your house to an insurance company. You get a tax-free lump sum and you don't pay interest on it. Obviously, because it's not a loan. You actually own that money. It is your money. Now, plans are regulated, and a lifetime lease means that you'll be able to continue living in your house until you die or move into full-time care without having to pay any rent on that portion that's owned by the insurance company. You can also protect a share of your home to leave to your family. So that's a little bit better in that way than the lifetime mortgage. Now, these Homes for Life plans can also help you with inheritance tax planning, because they actually remove your property from the estate. And that means also, as property prices rise, you'll benefit from increases in the value of the share that you still own. They're also portable, so if you decide to move, you can move the mortgage to your new home as well. But there is a downside, because if you downsize, you will have to pay back to the insurance company a portion of that money. But there are some cons to this. For example, you're not the sole owner of the home, so you're going to have less to leave to your loved ones. It's also very expensive if you want to end it early, because you will have to pay back to the insurance company the market value of your share. And if that's gone up substantially, you're going to be paying back a lot more than you actually borrowed from them. And there can be large setup costs for surveyor's fees, legal advice, arrangement fees and so on. So you need to keep that in mind as well. It is a less popular option because of the fact you don't own all the house anymore. So take advice. Now, the third option is a retirement interest only mortgage. Now, these are aimed specifically at people who are our age, people 60s, 70s, pensioners, and they're generally easier to get than a normal interest only mortgage. Now, these mortgages will grant you a one-off lump sum, and you may well have to provide evidence of your earnings and of your pensions, because they want to be sure that you can afford the repayments. You'll also be paying the interest on that loan each month. But it does mean when the house is sold or you go into full-time care and the loan has to be paid off, you'll only be paying off the lump sum that you borrowed, because you'll have already paid the interest. So all you have to do with this is to prove that you can afford the monthly repayments. So that could be an option that you might want to consider. Now, there is a little ruse that might be suitable for you if you want to not be forced into selling your property when you go into full-time care. And that's called tenants in common. Now, generally, people assume that if they're in a joint mortgage or spouses are living together in the home, that they each own half the house. They don't. They own the whole house. And that means when one of you dies, that whole house goes to the surviving spouse or partner. When they die, the whole of the house is assessed for tax, for inheritance tax and all the rest of it. And you would then, the house would be sold as well to pay off all these debts. With tenants in common, you take out an agreement that means you only each own half the house. So when the first partner dies, their half of the house goes into a trust and it can't be touched. And that trust is managed and owned, in effect, by your loved ones. The surviving partner then carries on living in the house for as long as they need to or want to. And if they go into full-time care, they can't be forced to sell the house to pay for the care or to clear any mortgages because they don't own the whole house. This was originally done to try and limit the death duties liability. The thresholds are quite low, and it began to be that your average householder could fall foul of having to pay 40% death duties. So this was a way of mitigating that. The thresholds have since been risen, and it's not so applicable these days, but have a word with your solicitor, because it might be a way that you can avoid being forced into selling your share of the home to pay off these lifetime mortgages. They do have to be paid at some point, so bear that in mind, but it's worth seeking advice to see if it will help in your situation. Now, please don't make any decisions based on this video. Just treat it as part of your research. Instead, take the salient points you want to, go and see an independent financial advisor, make sure he is independent and isn't trying to sell you specific products. And having seen your advisor, go and see your solicitor and just run past him what you're going to do to see if he can see any pitfalls you might not have thought about. He might have other suggestions for you. Just make sure that you're armed with everything you need to make an informed choice and decision that's right for you. Great. Now, Facebook. Now the domain apparently of older people. Apparently the younger ones are all on Instagram and TikTok and Snapchat and things like this, leaving Facebook for the older people in the world. Yes, right. Now, there is a brilliant group on Facebook called Born in the 50s. It's full of nostalgia. It's all the things that we would recognise. They talk about anything and everything to do with that period of growing up. So there's loads of reminiscing to do from kitchen gadgets and cars and films that we used to watch, lifestyle, things we used to do. Do you remember this? Do you remember that? So many memories will come flooding back for you if you were born in the 50s, maybe even the 60s, maybe even the 40s. There'll be a lot of memories there for you. It's a very friendly and very active group, over 25,000 members at the moment. Go and join them. I don't think you'll regret it. If you do a search for Born in the 50s, you'll see their cover page, which has got Twiggy and the Beatles and all that sort of stuff, and the Union Jack. You'll recognise it from that. Join the group, get involved, share your memories and have fun. And that's what we're about a lot of the time, is having a bit of fun. And I hope we're going to be doing that soon with Jess Mitchell, returning for a chat about the perils of growing old. And there are a lot, as we know. I hope by the time I see you next time, maybe that the treatment will have been finished and I can get rid of this dreadful baseball cap. And in the meantime, please leave any comments if you've got anything to contribute about equity release, maybe the pitfalls, maybe issues you've had with it, and your advice and recommendations. If you're a financial advisor, please leave us your views. It was actually impossible to get a financial advisor to appear on the show because they're worried about liability. They don't want to give advice, blanket advice to everyone and have someone sue them. I'm not worried because I'm not giving you advice. I'm just giving you some details that you can get anywhere. But hopefully finding it here will help you searching about a little bit. In the meantime, thank you for joining us, and I'll see you next time on Grey Matters. Bye for now.